Hello, I'm Andrew Webb, the Englishman in Dallas, the realtor who treats you like royalty. And this is Scott Horn of Horn and Associates. What do you do, Scott? What is it exactly that you do?
Too damn much, to be honest with you. There are days, aren't there days you just want to go get the heck out of Dodge and lay on the beach or do something?
Yeah,
No.
and forget all about creative real estate.
Oh, it's just everything anyway. You know what makes life fun today? And you say, what do we do? And you mentioned Horn and Associates PC, right? That's our law firm.
Yeah,
But we do so many things. I mean, in our law firm, we are a residential transactional law firm, which means we work with realtors and investors helping get their deal closed, contracted for, closed, whatever it entails. We work with real estate investors, same thing, but also in the creative finance world, meaning buying homes creatively. That means with direct seller financing. That means subject to the existing debt, which is not an assumption, or a wraparound mortgage, and vice versa, working with them on their flip side to their back end home buyers as well. Along the way, we help our clients with landlord tenant issues should those arise, and unfortunately, those occasional foreclosures. We do that all around the Texas marketplace. And of course, the flip side to Horn and Associates is our title operation, First Option Title, which we have offices here in the DFW Metroplex as well as San Antonio. Hopefully, getting ready to expand to the Houston marketplace soon. We'll see how that plays out. So we're a traditional title company with a little bit of an emphasis and flair on the investor world, helping them get their deals done, whatever that may look like. And we close transactions not only throughout Texas, but nationally as well, which is kind of awesome for this industry. But Andrew, that's just what I tell people what I really do because I understand it. Because when you tell people you buy houses professionally for a living, they don't understand that too well. So we are a professional home buyer. We are professional lenders from a hard money or asset-based lending perspective. We are home builders. We are vertically integrated into the single-family residential investment marketplace from all of those prospects and providing other services that include everything from loan processing, if you're working with a owner-financed buyer, to loan servicing, and all the things that entail and involve the creative finance business, the single-family residential business, closings, title, you name it.
So you mentioned owner finance, and that's something that I just wanted to touch on there, because when people think of owner finance, they think of owner finance, seller finance. They think that of buying a house where the seller owns it outright.
Yep.
Okay, so that's one form of seller finance, undisputed. But I want to really touch on owner finance wraps.
Okay.
Okay, so if we could just talk about what an owner finance wrap is.
Well, in its basic form, a wraparound mortgage is where the seller has an existing lien of some type, a mortgage lien typically, and they are going to sell the home to a buyer, and that buyer executes a new note deed of trust, which is a mortgage, to the seller. So the seller becomes the buyer's bank, and the buyer's loan wraps around and encompasses the seller's existing mortgage. Oftentimes it's for more money, probably a higher interest rate, and a different term, usually more than what the seller has. For instance, maybe the seller owes 20 years on the mortgage.
Yeah.
The buyer's term is 30. Maybe the seller owes $100,000 on the mortgage. The buyer's new loan is $150,000. Maybe the buyer has a 6% interest rate, and or excuse me, the seller does. Now the buyer's rate is maybe 9%. And really, it's about the flow of money.
Yeah.
You know, Andrew, so if you are a homeowner and I'm the bank, your mortgage company, you pay me every month, right?
Yeah.
Awesome. So on the flip side, if you sold the property to a home buyer, the way the money flows is the buyer pays you and you pay me. Very simply. Now, knowing that, of course, in the creative finance world out there, we're not really too keen on the buyer paying our sellers direct when there's a wraparound mortgage because of that obvious thing that just stares you down. That means fraud.
Yeah.
No, unfortunately, sellers can put the money in their pocket, not pay their mortgage company, things happen,
Yeah.
house gets foreclosed on.
Yeah.
So we always incorporate a loan servicer into the middle of that deal in order
Yeah.
to protect all the parties.
Yeah, exactly. Now I can see this being implemented in there's two scenarios here. You've got the real estate investor who buys a property and then straight away they put it on the market at a higher interest rate. So let's say, for example, they buy, and whether they got it on a DSCR loan or some conventional loan at 7%, they then wrap it. We originate a new loan at say 11%, and then they've got the 4% markup every single month.
Mm-hmm.
So that's one strategy, and that's a great strategy. But the other one is you could use it. Here's a good one. So let's say someone bought a house 3 years ago at the height of the market when the prices were high, yet the mortgage rates were 4%. Right, that's when you could get a 4% mortgage back in 2021, or in some cases even lower. I've seen as low as 2.875. They need to sell now, but the thing is, they just don't have the equity there. So if they sold now, so if they bought their house at say 400,000, but now they can only get 380 for it, and it's been hanging around on the market for a long time. And if they sell it traditionally, well, effectively, they're going to have to bring money to the closing table after they've paid the realtors and they've paid their closing costs. It's going to cost them money to come to the closing table.
Yep.
So my idea would be, what they should do is they should sell it on seller finance using an owner finance wrap. Because if you've got a 3% mortgage, well, what's to stop us doing a wrap for 5.99%? And now we'll be beating the banks, because the banks are charging, what's a mortgage now on the high street? If you go and get a mortgage now, it's like 7%. So if we wrap that 3% into 5.99%, they've got a 3% markup, right? So the person selling their house is not only going to get their asking price for their house, they're going to sell it quickly, because we're going to drive more traffic to that particular house because we're doing seller finance at 5.99% in these particular circumstances.
Well, I'm just going to fill in a few gaps, because you are exactly dead on point, and there's a huge amount of that in the marketplace right now.
Yeah.
Exactly what you just described. They bought the house 2-3 years ago. They have no equity. If you're in the real estate business, you understand that it takes years to build up enough equity by paying your loan down or the house going up a little bit in value before you can sell it and just break even by paying your realtor fees and your title fees and those kind of things, right? So, what I find interesting, what I like, especially for other realtors to understand, is in the traditional realtor world, you are bound by what a house will appraise for to sell it.
Yeah.
So in your example, if they bought it for 400 and today it's worth 400, you're stuck. That's it. And if they owe, $390,000, they're losing money just to sell the house and get out of it. And as you said, if they have to sell, they got a problem. But I love to always present to the agents out there that what's any house worth?
Well, what anything's worth is what someone's going to give you for it right now.
That's right. It's what someone's willing to pay for it. So could you take a $400,000 house in the seller finance world and sell that home for 410 or 415? The answer is yes. So why? A, it's worth what someone's willing to pay for it. And B, there is no mortgage company. You are the mortgage company. There aren't any mortgage fees. So it's almost a wash. So that buyer can come up with that $15,000 as a down payment. Maybe the loan is $390 in this case. They come up with $25,000 down. You owe the bank 4%. You charge them 5.99. You get some money back in your pocket. You're collecting a premium spread of 3%, almost 2% on your mortgage. Not bad. You solved your problem. You helped a buyer buy the home. And you ask, why would that buyer for a minute do all those kind of things? Well, A, they become a homeowner, right? And two, they get that little nuance that's called a tax write-off. So they get all these great benefits other than just going out and leasing that home out there.
And actually, in those circumstances, you're going to drive the price of the house up, especially at the moment, because it's very much a buyer's market. But when they'll be attracted to that
Oh,
5.99%,
heck yes, they will.
right? However, what I would say, one has to be aware of the potential risks because, yeah, it's very, very appealing to, let's say your principal and interest at 4%. Let's pull a figure out of the hat and let's just say you're paying $1,500 principal and interest on that 4%, but we've now sold at 5.99%. So what did we say? 1,400. Let's say they're paying you 1,800. So you've got this $400
It's gonna be
a
more than
month.
that because you're gonna make an $8,000 a year cash flow, positive cash flow on
Right.
that. So you're gonna be paying
Let's give us
$600 or $700 a month more.
$700 a month more passive income for doing nothing, right? And that just flows and flows and flows and flows.
Yep. And another thing that a home seller can do in those scenarios,
Yeah.
you don't have to be a mortgage company and play their games. You could give them a long-term fixed rate loan, 15 years, 20, 30 years, standard stuff, right? But sometimes these sellers, they might want to go, hey, let's see if we can get this paid off a little bit sooner.
Right.
So could a seller do a balloon payment where that loan is due in 5 years, 7 years,
Yeah,
10
of course.
years?
They
Sure
can
you
do
could.
whatever they want because it's creative. We create what we like.
Yes, whatever you can negotiate.
Yeah.
And maybe you get that buyer in there at that great 5.99
Yeah.
rate day one.
Yeah.
And you go, guys, I get it. That's the introductory rate.
Yeah.
Let's make it 7% in year 3. Let's make it maybe 8% in year 5.
Yeah, you just touched on something really interesting there about you touched on paying it off early because there are going to be some sellers that are just, especially if they're not seasoned investors, like the sort of scenario that we're addressing here. This is not someone who's a
No.
seasoned investor. This is someone who's stuck with a house that they're trying to sell, and now we've got them in a position where they're cash flowing, right? That's because we're good at what we do.
Yep.
So they go, oh, actually, Andrew, do you know what? I'm not comfortable with having this underlying lien. I've signed my house over to someone else. Yes, I'm taking money in because I'm in a second lien position, so I'm their lien holder, but I've still got the underlying lien in my name. I'm not that comfortable with that. Now, there are options that they could sell the note.
Well,
to on a note exchange on the market, couldn't
you
they?
can, and that's a whole different science, by the way.
Yeah.
And keep in mind, I'm going to give you a real life example for
Yeah.
everybody there that we just did this recently. Could the note be sold? It is possible.
Yeah.
The note marketplace, though, we're talking this 5.99 rate.
Yeah.
The marketplace usually looks for a little bit higher interest rate for that,
Yeah.
and they're looking for maybe a little more equity in the deal.
Yeah.
But is it available? Yes. And by the way, what's really interesting is deals like this come in all shapes and sizes and all dollar amounts for various reasons, right? Maybe this house they bought for $400,000, today they only owe $350,000, but maybe it needs some repairs to it that they can't afford to do, limiting their options to sell it to a buyer. Okay, well, there are tons of buyers who have the ability to make those repairs, whether it's painting or carpeting or some other issue that could be around there, that would buy that house, with a lesser down payment and agree to do the work to the home themselves and take care of it. That still helps get it done. In the traditional realtor world, there's a thought process, though. You have to sell it for appraised value. You got to find an A-plus buyer who can qualify for the loan, and the house has to be in pristine move-in condition. And by the way, I get it. A lot of home buyers, that's what they want. But on the other side, there are tons of the other buyers who don't mind doing a few things. Maybe they're contractors already themselves or something like that along the way. And there's a myriad of issues that you can run into that can happen out there. And it's all about putting the deal out there in a proper format, having someone who knows how to structure and analyze that deal properly.
And I would say that if you are going to if you're going to do a seller finance or an owner finance wrap deal at a lower interest rate, because a lot of seller finance, the way that investors will structure their deals, you've got two types of markets. So one market is poor credit, possibly no social security, and that's one market, and they're typically going to pay over 10%.
Could be.
Right. And then this market that we're talking about here, where you're trying to attract a big pool of buyers in, and you're going, right, I'm going to do it at 6%, 5.99%.
You're getting that much better quality buyer.
So you could, if you wanted to, you could say, well, I'll just take the first one who comes along. I don't care if they got a 500 credit score, but I would personally be hesitant to do that. If you're offering at 6%, which at the moment is a huge concession, that's a big attraction. I would actually be quite discerning, a bit more discerning about who you have take it, because if you ever had to sell that note, this is hypothetical. If you ever had to sell it, you've got to put yourself in the shoes of the investors who are buying the note, because if you've done 6% is pretty low on seller, a very, very low rate on seller finance, but if you haven't got someone with a good credit rating, it sort of devalues it's not bringing the potential investors or the buyers of the note value.
Right.
That's one thing. Whereas if you've got the higher interest rate, then they'll they'll take it on the chin. They know that they're going to get a 500 credit score or no.
Well, it is. It's sometimes interest rate equals credit or no credit.
Yeah.
Versus that buyer who comes in who has a 740 credit score, they can pick up this 5.996% rate without going through all the hassle of a mortgage company and all the extra fees and all those kind of things. Maybe they own the house; it's done quick. Awesome.
Yeah.
There are so many people out there, and what I find disconcerting in the realtor world is, again, realtors are taught to walk around with blinders on. One little thing, you got to fit in this box, and that's it.
Apart from me.
And you have to get out of that box and go, oh my gosh, there's a whole other world out here that is really substantially larger than that world.
Yeah.
Only about 15 or 20% of the American population can actually qualify for an A-plus mortgage.
Right.
That was a couple of years ago.
Yeah.
It could have changed a little bit since then. I don't know, but that was a pretty close number back in those days. And what I found was interesting was when they came in and they made the banks max out at 43% debt to income ratio. I think they may have tweaked that up just a little bit recently, but not too much more. It knocked down another 5% of the population for qualification purposes. And you're going, holy cow. And for those realtors who live in that little particular world, you're dealing with that 10, 15, 20% crowd who can actually qualify.
Yeah,
but
exactly.
80 to 85% of the population out there could be very legitimate buyers.
Yeah.
If you've got the right people to work the deal for you, who understand it, help analyze it properly. And then, of course, your sellers want to know, how am I protected?
I'm just going to get onto that, actually, the risks.
Yeah.
So you're a seller, and you're thinking of doing an owner finance wrap. Now, naturally, you're going to think, well, what could possibly go wrong here, Scott? so I'm gonna kick off with my old favorite. The bank find out, and then they call the note due. Yeah. So, what risk does this really pose on both parties here?
Well, I think what you want people to walk away with is to understand a very simple concept. Number one, banks are not in the real estate business. They're in the finance business. They just want their money, and they do not want to own your home. So, could it happen? Sure. Does it happen often? Absolutely not. In the gazillion, and I say gazillion, whatever that number is, bazillion.
Yeah.
Okay, maybe not quite that many.
Like 0.0001%.
Yeah, but 10,000 deals I've closed in this business in our law firm over the years. I've had 13 total due on sales. That's it.
And 10,000.
I'm sure there's more out there that have occurred.
Yeah.
But you just don't see it that often.
Right.
But can it happen? Yes. I've been able to get around that for our clients up to this point in time. But because it is a viable risk, the most important thing is disclosure between seller and buyer. So everybody goes in with their eyes wide open, because I believe that when you have a willing seller and a willing buyer with full disclosure, And I add a little time factor in there so they have a chance to review the paperwork, seek counsel, real estate counsel, financial counsel, legal counsel, whatever they want to do.
Mm.
You have a good transaction, and it's a win-win for the parties and for the agents involved as well.
Mm-hmm. Now, is there any risk to the agent, for example, if I was to facilitate one of these transactions and then later, for whatever reason, it goes awry? Could my client say, "You told me to do that.
No.
This is your fault"?
Well, by the way, sometimes agents do put their feet in their mouth, right?
Yeah,
Gosh knows I've done it a time or two. But, you know, the important thing is realizing what is an agent's role in a transaction. It is to marry a buyer and a seller together
mm,
and provide them real estate advice, not legal advice.
right.
So, don't ever provide that legal advice out there. I'm sure you know that by the
Yeah,
back of your
I
hand.
keep my mouth shut.
Yeah,
Yeah.
there are days I need to do the same thing too. But because of that, brokers and agents, they have concerns.
Yeah.
And we recognized this years and years ago. And we came up with what we call the 4x4 rule. And I did the 4x4 rule because I need to idiot proof things because there are days I'm just an idiot. I don't like to think too hard. So, what's the most popular car in Texas? Do you know?
Is it a Ford F-150?
It's a pickup truck.
Yeah.
4x4.
Yeah, that was a good guess.
Good guess, right? Yep.
I've been here long enough to know that.
So, you can learn that real quick.
Yeah.
So, it's easy. So, what does that mean? Well, it's the 4 people to incorporate in every deal: a knowledgeable real estate attorney, a note pro,
Yeah.
someone like myself, even you, who understand the deal,
Yeah.
a loan processor, if and when necessary, to collect financial information, and/or the loan servicer.
Yeah.
Okay, that once you incorporate that in there, you solve most of the problems. Therefore, our compliance issues. Am I under the Texas Property Code? And if so, what does that mean? Okay. The SAFE Act, are we related? Do we have to deal with that at all?
Yeah.
The Dodd-Frank Act and RESPA.
Yeah.
Okay. When you comply with all those scenarios and put them together, and by the way, this is not what the realtor does. This is what the right people in the business do. The knowledgeable real estate attorney, for instance, who
Yeah.
understands this business, who can bring to the table the knowledgeable loan processor, the note pro, the servicer. You have now lowered the barriers and taken away 98% of all the issues that a broker has, that buyers and sellers have, and you solve the problems right up front before there ever even is a problem.
Yeah. Yeah. Another risk.
Mhm.
Okay. This one is a risk for the seller.
Yep.
What if the buyer stops paying?
Well, the buyer's going to be secured, or excuse me, the seller's going to be secured by a deed of trust,
Yeah.
meaning very simply, they have the right to foreclose.
Yeah.
And here in Texas, we have a very conservative foreclosure scenario.
Right.
It's providing the buyer a 20-day notice to cure the default. If they don't do it, you can then accelerate the loan and post it 21 days before the first Tuesday of the month. So you can regain that property back in as little as, really 43 days if
Right.
you move really fast.
You get the title
But
back.
about 60 days. You
Yeah.
get the title back,
Right.
you own the home.
Yeah. Yeah.
And can things happen? Yeah.
Yeah.
In fact, I was on the phone last night with a lady on a deal we're working on, helping her out. She's going, well, what if the buyer doesn't pay? And what happens? I said, well, your client's going to keep paying you. Oh, they're not going to stop paying you. Just because their back end buyer doesn't pay doesn't mean they're not going to pay.
Mm.
She didn't think about that. Well, what if they don't pay in the middle? I said, well, when you foreclose, you wipe out everybody and you decide who you want to work with, or you take the home back, and you sell it and you move on.
Yeah.
And you help people understand what those issues are. And by understanding them, you can eliminate them very quickly, show them how simple and easy it is. Now, can Armageddon happen? Maybe a bankruptcy get filed? Maybe. But
Mm.
two things that I want to make clear. I have yet to ever find anybody that wants to be foreclosed on. So there are easy solutions like a deed in lieu of foreclosure, a good way to take the house back.
Yeah.
And have you ever found anybody who wants to file bankruptcy? Heck no. I
Mm.
mean, that's just from bad to worse. No. Now, can that happen from time to time? Sure. I call it the idiot factor out there. You can't prevent the idiot factor. But typically, if you help people, if you handle things properly, open lines of communication, you show how to solve problems, you can eliminate all those issues most of the time.
So, how many with a deed in lieu of foreclosure, for example, is that something that would be signed at the closing table?
No.
Okay. It's so. What amount of time passes before you start talking about foreclosure? Is it like one or
Oh,
two, three, four, five payments
oh heck no.
missing?
It's one.
Oh,
You know,
really? So if they're
first
third,
payment's due on the first. Let's say it's late on the 10th or the 15th.
yeah,
I'm making some phone calls. I want some communication because I'm not Bank of America. I'm not Wells Fargo or some of these big.
yeah,
This is my money. I need it.
yeah,
I can't allow you to live for free. I'm sorry.
right.
So I'm gonna be very proactive in that
So they miss one payment and they're at risk of you foreclosing on them.
immediately.
Okay, all right. No, that's fine. And actually, when you think about it, if somebody stopped paying you, let's say they've been making their payments smoothly for 5 years, something like that, I would actually, as an investor or a note holder, I would kind of actually want them to stop paying me.
Sometimes,
I would actually be sort of rooting for them to
oh,
not pay me because, I'm going to get my house back. I'm going to foreclose on them. I'm going to take my house back. Perhaps I sold them the house for 400 grand and the note is 350 and they've been paying me
for
for
5
5 years,
years.
right? Most of which is just interest. Most of that's interest. They haven't paid a great deal of principal in that time, and I take my house back in 5 years. What's my house worth 5 years from now? Certainly a lot. I
Yeah,
mean, I would think, given the current trends in DFW, a great deal more.
it could be.
And all I do is I take someone else's. I maybe put some new carpet down and new paint on the walls, do whatever needs to be done, and then just sell it again and reset the clock on the note, start another 30 years to someone else, and take someone else's down payment.
Well, what's funny, Andrew, I'm glad you brought that up because what I call this business that way is that I am the used car marketplace of houses.
I used to be a used car dealer in England.
Tote the note lots, right?
Yeah,
They do the exact same thing. And when you can get in that mental mindset, if I was a grease monkey, I might have been a car dealer. I'm just not a grease monkey
yeah,
because you can get so much higher rates and whatnot. But with my home, what I love about it is if you're in the used car business, yeah, they can drive your car down to Mexico if you live in Texas, right?
yeah,
They ain't going to drive your house to Mexico. And the other thing I find interesting too is homeowners take so much better care of their home than like a tenant does.
yeah.
Same way like
Of
renting a
course.
car versus owning your own car.
Well, it's that 10%, 15, 20% that they have to that comes out of pocket. That also, not just that. What I say to agents when they're phoning me up and saying you've got a house on seller finance. Yeah, this is a seller finance wrap. What does that entail? And I tell them what it entails. And I said, by the way, you need to, if you're saying your client has 25, 30 grand to put down, they haven't really, because out of that, they've got to fill up an escrow for 1 year. They've got to prepay into the escrow. So they've got to pay their insurance up front and they've got to pay a year's taxes, because this is all going to be done properly. We're going to use a lawyer. We're going to use a loan servicing company.
Mhm.
And as part of the requirement is that they prepay into the escrow
Sure.
12 months.
Yeah.
So if they think they've got 25 grand, and that's all they've got, the seller's not going to get 25 grand
No.
because probably a fraction of that will be going into the escrow.
Yes, there will be.
Yeah,
But it works just like that though. And, you know, houses typically appreciate here in Texas about 2% a year.
mm.
There are some big swings, some every once in a
Yeah,
while
of
based on
course.
influx of people and whatnot. We saw that during COVID and those kind of times. Um, so your mortgage payment's going down pretty quick. Theirs moving slowly. Values going up. And so what I have found historically is both on the legal side as well as in the investment side of this equation is that you almost always come out a winner.
Yeah,
Almost always. I'd say, gosh, 94% of the time, at least, you come out on the upside. Very worst, you break even, that the buyer's down payment repays you any cost of minor repairs, any unpaid monthly payments,
yeah,
get recaptured at the time of resale, and you just keep the ball game going with a lower loan balance and oftentimes a higher sale balance also.
Oh yeah, completely. And I think possibly one of the worst things that maybe the worst thing that could happen is you're going through a foreclosure, and then they inform you that the person in the house, the buyer, has filed for bankruptcy.
Yep, that stinks. That happens.
Yeah, that's like probably the
Yeah.
worst news you
But
could
the,
get,
the
isn't it?
worst news of that, though, is in the bankruptcy courts today, yeah, there's going to be a 60-day period in which something could happen.
Yeah,
There's a lull. But after that, whoever is the obligated party to pay has to start paying, or they will be removed from that property.
yeah. I think that people have this, that they can be lulled into this false sense of security. I'll file for bankruptcy. That will protect me, and it doesn't.
No,
All it's going to do is just a delay tactic. It's not going to do anything, and actually, it's probably the biggest wound that one can inflict upon themselves, isn't it?
well, bankruptcy is horrible. Foreclosure is horrible.
Yeah,
Bankruptcy is horrible, and it lasts for years on your records
exactly.
and whatnot. No one wants to do that.
Yeah, so
Yeah.
they're going to be restricted with where they can
Yep.
rent, who they can rent from. So yeah, it's going to be 7 years of sheer misery.
It is. And again, as I said earlier, I have yet to find anybody who wants that. Now, I will also say bad things happen to good people all the time, and there's sometimes a need or a necessity. I get that.
Yeah,
Then you have that idiot factor, as I say, that they're just going to do what they're going to do regardless, and they don't
right.
care about the credit.
It's always someone else's fault.
It's all, yeah.
Yeah,
But most people, the common person, does not want to go that route.
no,
They're
no.
looking for a solution. And so
Yeah, they
long as
want
you
to
can
fix
help
their
them and
problems.
give it to them, they will reach out and they'll take it almost every time.
Yeah,
It's just learning that game. But so often there's so many um, things floating around in the marketplace on, oh my gosh, this could happen, that could happen. They're always talking the negative,
mm,
but they really don't understand how the business really works. And it's understanding that you got to pull back, get out of your little cubicle you're in, and open your eyes to a bigger world out there and realize there's a huge amount of people that buy this kind of stuff. No one wants to go through a foreclosure. Nobody wants to go through bankruptcy. Nobody. Sometimes it happens, not much. I can tell you in the 7,500 plus houses I have been associated with personally on houses we have bought and financed, bankruptcy maybe 10, 12 times total over 25, 30 years.
mm,
Again, but we've learned a mechanism to talk with people and work with them. We
yeah,
don't pick up the phone and call and holler at them and yell at them, those kind of things.
yeah,
Let's work this out, guys. And so often, if you find a mechanism doing that, it works. Not always, but most of the time, if you're reasonable, they're reasonable. That's all most people want.
mm.
And it works out awesome in those situations.
Well, I think it's a win-win situation because you're helping people into become property owners that, like you say, was it 20%, 15, 20% of Americans can get the very best mortgage
Yeah.
rates. That's not many, really, when you think about
No.
it. So you're helping out. There's a lot of people who we're making this possible. We're making home ownership possible. It opens up business opportunities for investors. It's a win-win all
It
round.
is, but it's really, I get the investor side, but what I think I would want realtors to really understand is this is a extremely viable mechanism for a seller who needs to move reasonably quickly, who
Yeah,
may have limited options for selling. And there are ways to work with that back end buyer from a reasonable perspective. If you're going to offer somebody a 6% rate below market,
yeah,
I want a 5-year balloon. Okay. And if I'm a good enough buyer to do that and my credit's pretty decent, overall, and I'm not some C minus DF or barely breathing type credit guy out there, as I say, they're going to do that because they're getting that great rate right now.
yeah, completely.
And they know they can go out later on. I had a guy one time on a $1.2, $1.3 million home. Gosh, this is probably 6, 7, 8 years ago now. You're going, wow, seller financing on a deal that big? Yep.
Yeah,
One of these great low rates, like 2.5% to 3%, something like that, on a big house like that. Awesome rate. And the guy comes and goes, I could write a check for cash and pay this off if I wanted to. I can go get a mortgage tomorrow. But why would I not take advantage of this low rate? If the
Yeah,
bank ever calls
exactly.
us to, done. There are tons of
Yeah,
people out there just like that, looking for an opportunity and to work together. And the key is learning how to marry those things together. And that's what
yeah,
you realtors are good at,
yeah,
is the marketing side.
yeah. I mean, I'll be honest with you, Scott. I don't want too many realtors knowing how to do these creative operations, because otherwise it takes away from my
No,
exclusivity.
but it takes, and by the way, what's cool is this. I would love to see a lot of agents do this. They just don't do it. It
Yeah.
takes a special person to do that. It takes someone who I call the note pro who understands this. And
Well,
so
I learned
often,
it. I devoted a lot of time into learning this,
yeah,
and you know what? Once you get your head around it, and you find out how it works, so I could teach it now
yeah,
to
but that's what it is.
people.
You became a student of the industry,
Yeah,
which is what is so important to do and to understand how this stuff works. And what is, again, so
I
unfortunate
learned a lot
is,
from you as well.
oh, okay. But, most people, I hate to say it this way, they're lazy.
Yeah,
They want to do their thing that they're comfortable doing. They don't want to get outside their comfort zone, and
yeah.
they're happy where they are. I get it.
They just want an easy
No,
life.
and again, it's that 90-10 rule. I think no, 10% of us crank out 90% of the work,
Right.
and it's by learning how to do things like you just described,
Yeah.
and it really works.
Yeah, definitely. It does. It's a win all round for sure. Well, I think that just about concludes that, Scott.
That was
Thank you
awesome.
so much. That was
Nope,
great. Thank
all
you.
good, man.